Source code speaking, John JD here. One handle, two platforms. At JohnJD_silver. The handle is the only fingerprint they can't forge. Write it down, verify it. Because what I'm about to show you is going to get copied, repackaged, and twisted by every copycat channel within 24 hours. Drop JD in the comments if you watched the video I posted 48 hours ago. Just 2 letters, JD. That tells me you were paying attention when it actually mattered. Silver just exploded past $100. Not tested $100. Not approached $100. Exploded through $100. The spot price touched $103.47 before pulling back slightly. We're currently sitting at $101.82 as I record this. And here's what separates this channel from everyone else celebrating right now. We called this 48 hours ago, not after the fact, not with hindsight analysis, before it happened. And I didn't call it with gut feeling, I didn't call it with hope, I called it with 3 specific indicators that were screaming at anyone willing to listen. Today, I'm going to show you exactly what those 3 indicators were, why they worked, and more importantly, what they're telling us happens next. Because $100 is not the destination. Let me say that again for the people who just tuned in. $100 is not the destination. $100 was the confirmation. The destination is much higher, and the same 3 indicators that called this breakout 48 hours ago are now pointing to a level that most analysts would call impossible. But first, let me be absolutely clear about something. I don't sell signals, I don't sell mentorships, I don't sell courses, I don't have a paid group. If anyone contacts you claiming to be me, offering any of that, block them immediately. They are scammers. I will never sell you anything, ever. I share analysis. You make your own decisions. That's how this works. Now let's get into exactly what happened. Silver opened the Asian session at $97.24. Within the first 90 minutes of Shanghai trading, it spiked to $99.81. The $100 test was coming. At 2:47 a.m. Eastern, silver touched $100.04 for the first time. The initial touch saw immediate selling. Price pulled back to $98.60 within 12 minutes. This is what happens at major psychological levels. Profit taking, algorithms triggering, weak hands exiting. But here's what happened next. At 4:23 a.m. Eastern, silver made its second attempt. This time it didn't just touch $100. It punched through to $101.35 and held. By the time London opened, silver was trading at $102.18. By the time New York opened, it had touched $103.47. Let me give you the numbers across markets right now. COMEX spot silver, $101.82. Shanghai spot silver, $114.26. Shanghai futures, $116.80. JD.com. Physical retail, $138.45 per ounce. Shenzhen buyback price, $129.70 per ounce. The Shanghai premium is now $12.44 over COMEX. That's a 12.2% gap. The Shenzhen physical buyback premium is $27.88. That's 27.4% over Western paper. Chinese retail is paying $138.45. That's 35.9% above COMEX. These are not normal premiums. These are not sustainable disconnects. Something has to give. Either Western paper prices rise to meet Asian physical reality, or the entire pricing mechanism breaks down completely. The market is telling you which option it's choosing. The breakout past $100 is the first confirmation. Here's the mid-video reveal that most channels won't give you. 48 hours ago, in my previous video, I highlighted 3 specific indicators that were signaling an imminent breakout. Not a gradual climb, an explosion. Let me walk you through each one, show you exactly what it said, and prove that this breakout was predictable for anyone paying attention. Indicator 1. The lease rate spike. Silver lease rates measure the cost of borrowing physical silver for a set period. When lease rates spike, it means physical silver is becoming scarce. Lenders are demanding more compensation because they're not confident they'll get their metal back easily. 48 hours ago, silver lease rates jumped to 2.34%. That doesn't sound dramatic until you understand context. The average lease rate over the past 5 years is 0.4%. We were at nearly 6 times the average. The last time lease rates spiked above 2% was mid-February. What happened immediately after? Silver ran from $89 to $96 in 3 trading sessions. The time before that was late January. What happened? Silver ran from $78 to $94 before the coordinated crash that we all remember. Lease rate spikes above 2% have preceded every major silver move in the past 6 months. Every single one. 48 hours ago, the lease rate hit 2.34%. I said watch for a breakout. Nobody wanted to hear it because silver had been consolidating for days. Today, silver is at $101.82. The lease rate was indicator 1. Indicator 2, the open interest collapse with rising price. This is market structure 101, but almost nobody talks about it. Open interest represents the total number of outstanding futures contracts. When open interest rises with price, that means new buyers are entering the market. That's bullish, but it's the obvious kind of bullish. When open interest falls while price rises, something different is happening. That means shorts are covering, shorts are exiting. The sellers who were betting against silver are capitulating. 48 hours ago, I showed you the data. Open interest had dropped from 142,000 contracts to 118,000 contracts over the previous 2 weeks. That's a 16.9% collapse in open interest, while price climbed from $94 to $98. Let me say that again. 16.9% of short positions exited while price was rising. When shorts cover in size, they're buying. When they're buying in a tight physical market, price explodes. There's no one left to sell. That's exactly what we saw at $100. The breakout wasn't met with massive selling, it was met with a vacuum. The shorts had already left. Open interest collapse with rising price was indicator 2. Indicator 3, the Shanghai premium acceleration. The Shanghai premium has been persistent for months. But 48 hours ago, something changed. The premium had been stable at around $10 to $11 for weeks. Suddenly, within 24 hours, it widened to $14.80. That acceleration told me something. Physical demand in Asia was intensifying, not stabilizing. Buyers were willing to pay more, not less. When a premium accelerates rather than compresses, it means local demand is outpacing global supply. It means the physical market is leading, and paper is about to follow. Shanghai premium acceleration was indicator 3. 3 indicators. Lease rate spike. Open interest collapse with rising price. Shanghai premium acceleration. All 3 fired simultaneously 48 hours ago. I told you then, watch for the breakout. Today, silver is past $100. This is not prediction, this is pattern recognition. The data tells the story, you just have to know where to look. Now looking at the analytics right now, roughly 74% of you watching aren't subscribed. If this kind of analysis is what you're looking for, no hype, no fear porn, no ridiculous price targets pulled out of thin air. Just data, pattern recognition, and honest both sides analysis. Hit subscribe. That's how I know the real community is growing. Drop JD in the comments. One word. It helps me understand who's actually here to learn versus who's just passing through. And let me be very clear. There are copycats everywhere now. Channels stealing my analysis, my format, even my exact phrases, and twisting them into clickbait. I am only on YouTube and X at JohnJD_Silver. That's the only way you verify it's really me. Anyone else claiming to be me, block them. Report them. Protect yourself. Now let's continue. Here's the question everyone wants answered. What happens next? Do the same 3 indicators that called the breakout tell us where silver goes from here? Yes, they do. Let me update each one with current readings. Indicator 1 update. Lease rates. Lease rates did not decline after the breakout, they increased. Current silver lease rate, 2.67%. That's the highest reading since the January crash. And remember what I told you, lease rate spikes above 2% precede major moves. We're now at 2.67%. The physical silver market is not relieved by the breakout. It's more stressed, borrowers are paying even more to access metal. Lenders are even more reluctant to let it go. This tells me the breakout is not exhausted. The supply squeeze is intensifying. Indicator 2 update. Open interest. Here's where it gets interesting. Open interest actually ticked up slightly during the breakout. From 118,000 contracts to 121,400 contracts. That means new longs entered the market as silver broke $100. Fresh buying power came in. But more importantly, the shorts that remain are now underwater. Anyone who shorted silver at $95, $96, $97, $98, $99, they are losing money right now. And here's what happens to underwater shorts. They either add to their position, hoping for a reversal, or they cover, which means buying, which pushes price higher. The short squeeze potential is now higher than it was before the breakout. Indicator 3 update. Shanghai premium this morning, $12.44. It compressed slightly from the $14.80 reading 48 hours ago. Some people might see that as bearish. It's not. Here's why. When COMEX price rises toward Shanghai, the premium compresses mathematically. That's just math. Shanghai at $114 minus COMEX at $101 equals $13. When COMEX was at $96, the premium was $18. The premium compressed because Western paper rose to meet Eastern physical. That's exactly what we want to see. That's price discovery working correctly. The question is, has Shanghai stopped rising? No. Shanghai spot was $109 48 hours ago. It's $114.26 now. Shanghai rose $5.26. COMEX rose $5.82. Western paper is finally keeping pace with Eastern physical. The dislocation is healing, and as it heals, price rises in both markets. So what do the three indicators tell us now? Lease rates elevated and rising. Short squeeze potential increasing. Shanghai premium healthy with both markets rising together. All three indicators remain bullish. Now let's talk about where this goes. I gave you the $117.40 target in my previous analysis. That target remains valid and is now closer than ever. But let me add context. The breakout past $100 changes the technical structure completely. $100 was resistance for decades. It was psychological resistance. It was options gamma resistance. It was the level where banks loaded shorts for years. Now $100 becomes support. Let me say that again. The level that capped silver for years now becomes the floor. When resistance becomes support, the next move is typically 1.5 to 2 times the previous range. Silver consolidated between $94 and $100 for approximately 3 weeks. That's a $6 range. A 1.5x extension from $100 targets $109. A 2x extension from $100 targets $112. Add in the Fibonacci confluence I discussed in the previous video, and the $114 to $118 zone becomes the high probability target cluster. The center of gravity remains $117.40. But here's what most people miss. When markets break out of multi-decade resistance levels, they don't stop at the first target. They overshoot. Look at gold. When gold broke its 2011 high of $1,920, it didn't stop at $2,000. It ran to $2,450 before consolidating. Look at Bitcoin. When Bitcoin broke $20,000 in 2020, it didn't stop at $25,000. It ran to $64,000. Major breakouts overshoot. That's market psychology. That's momentum. That's FOMO kicking in. If silver follows the same pattern, a move to $125 to $130 before any significant consolidation is entirely possible. Do I know it will happen? No. I don't have a crystal ball. Do the indicators support it? Yes. Overwhelmingly. Let me address the two different kinds of people watching this right now. First, to the long-term stackers. The accumulators. The people who've been buying physical silver for years, sometimes decades. Congratulations, this is what you've been waiting for. But let me give you one piece of advice. Do not let this moment make you complacent. You were right. The thesis played out. Silver broke $100. You're sitting on significant gains. But here's what happens to stackers who get overconfident. They stop paying attention. They assume the rest of the move is guaranteed. They get sloppy. Stay sharp. Stay disciplined. The thesis is playing out, but markets can still surprise you. Pullbacks will happen. Shakeouts will come. Your job is to hold through them with the same conviction you had at $20. And if you're a stacker who hasn't accumulated enough yet, understand this: the easy money is gone. Buying at $30 was easy. Buying at $50 was still comfortable. Buying at $101 requires more conviction. But if the target is $117 and beyond, buying at $101 is still buying below fair value. Make your own decision. Now for the second group, the traders, the speculators, the people trying to time entries and exits. This is the most dangerous moment for you. Why? Because you just watched silver explode past $100, and now you want to chase it. Chasing breakouts is how traders get destroyed. Yes, the three indicators are bullish. Yes, the target is higher, but markets do not move in straight lines. There will be a pullback. There is always a pullback after a major psychological level breaks. It might be 5%. It might be 10%. It might happen tomorrow. It might happen next week. But it will happen. If you chase here at $101 with leverage, and silver pulls back to $94 to test the breakout level, you could get liquidated even though the long-term direction is up. I've said it before. I'll say it again. Position sizing matters more than being right on direction. Time horizon matters more than entry price. A pullback is not a failure of the thesis. It's a feature of how markets move. If you're a trader, wait for the pullback. Let $100 prove itself as support. Enter on the retest, not the breakout. If you can't wait, at least position small. Small enough that a 15% drawdown doesn't destroy you emotionally or financially. Use your brain. Don't chase. Don't FOMO. Now let's address the bearish case. Because intellectual honesty requires giving you both sides. Here's what could go wrong. Bear argument 1. The failed breakout. Not every breakout holds. Sometimes price spikes above resistance, triggers all the buy stops, sucks in all the FOMO traders, and then reverses violently. This is called a bull trap, and it happens more often than people admit. If silver fails to hold $100 on a daily and weekly closing basis, the breakout is invalidated. Price could fall back to $92 to $94 quickly, trapping everyone who bought the hype. This is why I said wait for the retest. Let the market prove the breakout is real. Bear argument 2. CME margin hikes. The CME has raised margins on silver futures multiple times in the past 6 months. Every time price spikes, they raise margins. It's predictable. Higher margins mean traders need more capital to hold positions. Those who can't afford it are forced to sell. Forced selling creates downward pressure. A surprise margin hike over the weekend could trigger a sharp Monday sell-off. This is not conspiracy. This is how the system works. The exchange protects itself, and over-leveraged traders pay the price. Bear argument 3. Dollar strength. If the Federal Reserve signals more hawkish policy, if interest rates stay higher for longer, if the dollar strengthens against major currencies, commodities priced in dollars become more expensive for international buyers. Higher dollar equals lower silver. That's the inverse correlation. We haven't seen a major dollar rally recently, but it could happen. Economic data, Fed speeches, geopolitical shifts, any of these could spark dollar strength. Bear argument 4. Profit-taking wave silver just broke through a level that many traders have been waiting for years. Some of those traders have been holding since $18, $20, $25. They're sitting on 300%, 400%, 500% gains. A breakout past $100 could trigger a profit-taking wave. Long-time holders decide this is the exit they were waiting for. Selling pressure emerges not from bears but from bulls cashing out. Bear argument 5. Geopolitical de-escalation. Safe haven flows have driven some of the precious metals demand. Iran tensions, Middle East instability, uncertainty about global trade. If tensions de-escalate, if diplomacy prevails, if the world suddenly feels safer, the safe haven bid could evaporate. Precious metals would still have the structural deficit argument, but the urgency would decrease. These are the bear arguments. They're not irrational. They're not fear-mongering. They're legitimate scenarios that could play out. I give you both sides because I'm not here to sell you hopium. I'm here to help you think clearly. Now the bullish case, and it's overwhelming. Bull argument 1. The 3 indicators remain bullish. Lease rates at 2.67%. Open interest showing short squeeze potential. Shanghai premium healthy with both markets rising. The same indicators that called the breakout are not signaling exhaustion. They're signaling continuation. Bull argument 2. The structural deficit is accelerating. Silver Institute projects a 280 million ounce deficit this year. That's larger than last year's 215 million ounce deficit. Solar demand alone requires 1.18 billion ounces annually. Mine supply is 820 million ounces. The math doesn't work. The deficit is structural. It cannot be solved by higher prices alone because opening new mines takes 7 to 12 years. Every ounce above ground is being drained. COMEX registered, LBMA vaults. ETF holdings. The accessible supply is shrinking. Bull argument 3. $100 was multi-decade resistance. Silver has not traded above $100 in modern market history. The 1980 high was $49.45. Even the 2011 high was only $49.80. When a market breaks through resistance that has held for 40-plus years, the move that follows is typically significant. This isn't a normal breakout. This is a generational breakout. Bull argument 4. The gold-silver ratio. Gold is trading at $5,320. Silver at $101. The ratio is 52.7. Historical average is 47. Bull market average is 40. The 2011 low was 32. If the ratio normalizes to just 45, silver prices at $118. If the ratio reaches bull market average of 40, silver prices at $133. If the ratio matches the 2011 low of 32, silver prices at $166. The ratio expansion argument alone justifies significantly higher prices. Bull argument 5. Physical market dominance. Shenzhen buyback at $129. JD.com retail at $138. Shanghai spot at $114. Physical markets are pricing silver 20% to 35% above Western paper. This is not sustainable. Either paper rises to meet physical, or the paper market loses all credibility and physical markets take over price discovery entirely. Both scenarios are bullish for anyone holding actual metal. Bull argument 6. Central bank behavior. Central banks are buying gold at the fastest pace in 55 years. They don't buy silver directly, but they're signaling a monetary regime shift. When central banks lose faith in fiat currencies, precious metals benefit. Silver, as both monetary metal and industrial metal, benefits doubly. The bull case is structural, technical, and monetary. It's not hope, it's data. Here's what I'm watching over the next 72 hours. Watch the daily close. If silver closes above $100 today, tomorrow, and holds through the week, the breakout is confirmed. If it closes below $100 multiple times, the breakout is questionable. Watch the retest. Every breakout retests the breakout level. Silver will come back to $100 at some point. How it behaves at $100 as support tells you everything. Does it bounce immediately? Bullish. Does it slice through back below? Bearish. Watch lease rates. If they stay above 2%, supply stress is real. If they drop below 1.5%, some pressure is relieving. Watch COMEX inventory. Another drainage week confirms the trend. Any significant addition would be notable. Watch the Shanghai premium. It should stay healthy between $10 and $15. If it compresses below $8, paper is catching up. If it widens above $18, Asian demand is accelerating faster than paper can follow. Watch CME announcements. Any margin hike is designed to flush out longs. Be prepared mentally and financially. Watch the dollar index. A spike above 105 would create headwinds. A drop below 100 would add tailwinds. The data tells the story. I'll be watching and updating on X in real time. Follow JohnJD_Silver if you want those updates. 3 key takeaways, and we're out. Number 1. Silver's explosion past $100 was not random. It was signaled 48 hours in advance by 3 indicators. Lease rate spike to 2.34%, open interest collapse of 16.9% while price rose, and Shanghai premium acceleration from $11 to $14.80. These indicators fired simultaneously. The breakout followed. This is pattern recognition, not prediction. Number 2. The same 3 indicators now show continuation, not exhaustion. Lease rates have risen to 2.67%. Open interest shows short squeeze potential. Shanghai premium remains healthy with both markets rising together. The breakout past $100 changes the technical structure. Resistance becomes support. The next target cluster is $114 to $118, with potential overshoot to $125 to $130. Number 3. Both scenarios require acknowledgement. Bears have legitimate arguments about failed breakouts, margin hikes, dollar strength, and profit-taking. Bulls have structural deficits, generational resistance break, ratio normalization, and physical market dominance. Short-term is uncertain. Long-term trajectory is clear. Position sizing and time horizon matter more than being right on direction. The unresolved tension is this. Silver just exploded past $100. The indicators that called this breakout say more is coming. But markets don't move in straight lines. There will be pullbacks. There will be shakeouts. There will be moments designed to make you doubt. The stackers who understand this won't flinch. They'll buy the dips. They'll hold through the volatility. They'll let time do the heavy lifting. The traders who chase, who over-leverage, who don't have a plan, they'll get destroyed in the pullback even though the direction is right. Know which one you are. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan. Know your time horizon. I don't give financial advice. I show you the data, I teach you the patterns. You make your own decisions. The handle is JohnJD_Silver. That's the only way you know it's really me. Verify it. Protect yourself. If this analysis added value, subscribe. Drop JD in the comments. Share it with someone who needs to see both sides of this market. And remember, invest with logic, not hype. JD out.